Hello, everybody. This is Socrates and Tyler of Lucid Investment Strategies. And we are going to just pick up where we left off yesterday on the S&P 500 sectors. We did the first 6 of them. There's 11 altogether, so we've got 5 more to go. We did the biggest ones yesterday, which basically is technology, number 1, healthcare, number 2, financials, number 3, consumer discretionary, number 4, communication services, number 5, and then industrials was the last one we did yesterday. And what we're doing is we're looking at each of the S&P ETFs, S&P sector ETFs, and we will give you the symbols for the next 5 as we go through them. Socrates, how are you doing today?
I'm doing good. Might have had a few too many to drink last night. Still shaking out the cobwebs a little bit, but it's a bright sunny day and I'm happy to be here.
Terrific. Well, we'll get right into it. We'll keep it a little shorter than yesterday, but we do want to look at Bitcoin and Ethereum and Litecoin at the end of this. We had a little frisky action, and it looks to me like it's kind of running out of gas, but I know Socrates has got a different view on things, so that'll be fun. So I will pull up this, and all I've got to do then is find this. Here we go. Okay, that's Bitcoin. We won't get to that quite yet, and it's getting a little stronger again. Okay, so we're going to go to the sectors, and we're going to come down and start with number 7, consumer staples. XLP is the symbol. It's been one of the strongest, obviously, throughout this period of time. This is a 4-hour chart. I'm going to go back to the weekly, and you can see that not only is it a new high, but more importantly, as opposed to some of the other ones we looked at yesterday, this is a high above a high above a high. Huge candle here last week after trying to sell it off after this 9. Got negated. We blew right through it. Long-term moving average has been moving up for a long time, all the way since the summer of last year. Short-term above intermediate, intermediate above, stop and reverse points. Interesting. Wow. They actually dropped down after this big green, and now they're back to the upside. We'll have to take a closer look at that.
I think that the red one took it out. That violated the SAR, and then we got a one on top, and then we immediately took it out again.
Exactly.
Which you almost never see that happen.
Never. That's very rare. Shows how strong this thing is. Here's our setup trend line way down here. We're only on a 2 above a 1. So this is obviously the place to have parked money for quite a long time. It sold off like everybody else between September and December, but it only took us until April to break back through that high. Just looking at it quickly, we do have a 5, 4, 3, 2, 1. So it, as many of the other sectors and the S&P and the NASDAQ and the NASDAQ 100 are fighting this broadening top. What's interesting, though, is this is actually the first 5 right here, maybe even right here. But then after coming down, we would have broken up through the stops. So we are still working on a 5 after being stopped out of this short after this 9 on this big one. Anytime we turn down, if we were to turn down next week, this would become the next 5, but I wouldn't expect it after looking at this chart. Now, I am going to go back as we did yesterday and see it from the bottom, just amazing, just kept on going up. Take a look at all of the 9s at each of the peaks of each of these moves. I've got to show that to Tone Vase. And then another 9 right here, another 9 right there. Unbelievable. So the sequential is a great system to use on this particular sector. It is, once again, the XLP, which is consumer staples, the strongest of all of them we've looked at so far. I will make this a little bigger for Socrates. Any other observations on this one?
Just a question. What's the weighting on this?
The what?
The weighting, the percentage.
Oh, I'm sorry. I didn't say that. It is 6.74%, 6.75%. So it's just about 2/3 of the average, which would be right around 10%. So it's one of the smaller ones.
All right. It's looking good.
Okay, we'll go to number 8, which is energy, the XLEs. Very different story, obviously. Couldn't get above the highs from all the way back at the beginning of 2017. 1, 2, 3, 4 times. Gone to new lows in this move. Tried to rally back up and has been heading lower ever since. The energy weighting is 6% even. The symbol is XLE. And long-term turned down in October of last year, and it is still going down. Intermediate term has a death cross not too long ago, 3 candles ago. And it's in a fully bearish posture at this point. See anything there?
Nothing that I can really add. I agree that that is looking fully bearish, and looks like the RSI is below 50 and staying below, and it's not necessarily oversold, so it looks like it's even ready for another leg down potentially. ADX cross 25, that's interesting.
Yeah,
indicates that it's just starting a new trend, basically, that this is just the first beginning of a new trend, which would be a bearish trend based on how that's been moving. So yeah, it looks like that's right at the beginning, that TDST level that we see over to the left at 56. That definitely looks important. Breaking down that would be definitely a sell signal in my mind.
Yep, I agree. And we've got an aggressive 13 on the sequential, which is interesting, which is a buy. Where is that coming from? 1, 2, 3. Wow, must be way back there. There's 5, 6, 7. I'm not sure where it is. Anyway, that's interesting.
I think it's that 9 back in October or close to the end of 2019. We get that red 9, and from there it would start the countdown phase after taking out those lows, I believe.
Wow, they're so small, it's hard to see it. Let's see. How's that possible? That's
So if it's lower than the candle two before, then it will give us a number for the countdown. And we see on the green 8, we're getting a 4 right there. That's lower than the green 6. I'm not seeing the 3, 2, and 1. I see the 1 back there is right after the green, the red 9. On that red 1 is the 1. And there's the 4. And then on that, at the top, we get the 5, 6, 7, 8, 9. And now we're up to the 13 on the.
Oh, yeah. Okay, got it. Okay, so energy looking very, very weak. It is only 6% of the index, but nonetheless, that's pretty interesting.
Absolutely.
Okay, the next on our list is energy number 8, utilities number 9. It drops all the way down to 2.82%. And its symbol is XLU. And it, like the consumer staples, has been on a tear for some time and is even stronger than consumer staples, green 1 above a green 2. But notice that here in the sell-off period, which was September through December, this actually went up. It took it until December to have 3 weeks down, and then it quickly retraced it. Just unbelievably strong. One of the biggest reasons is because it has the highest yielding securities in it. Therefore, they pay big interest, 4, 5, 6, 7% on some of the utility companies, as opposed to just 2.5% on 10-year bonds. So a lot of money moves into this when they're moving into bonds during periods of weakness. And let me just take a quick look. Everything is fully bullish. Consensio says you need to be in it. We did have a C13 right here on this weekly, but it's being completely ignored at this point. You can see the copy curve is actually turning down, which I can't even begin to understand. I guess it's from this weakness here that lasted about 8 weeks, plus this weakness, but still, that seems very strange to me. Do you see anything else there?
I see that the parabolic SARs are working like a charm. Caught the wick of the prior 2 candles, pretty much to a T. And the Copic curve turning over and rolling down while the price goes up is something that's extremely interesting to me. I've seen that time and time again where it marks really, where it really does its best job at marking tops, from what I've seen, is when that goes counter to the price. When that starts rolling over and moving down while the price is bouncing, that is something that's a very important signal to me. I just realized that we're on the weekly, so seeing on the monthly is telling a different story.
Yeah, we were on the weekly, but it was so confusing to me. I thought I'd pull up the monthly. And on the monthly, you can see it just skyrocketing. It just broke through the 20 level. Here's the 0 level down here. It did get below the 0 level, turned around. It's been going up ever since October of 2018. Right when everything else was going down, this one has turned up. So I find that very interesting. And on the monthly, we're only on a green 6, and it's a green 6 above a 5, which says basically we've got 3 more months of this kind of action, which could mean weakness in the overall stock market, but not necessarily. So you've got two places to hide almost regardless of where the market's going, the consumer staples and also these the XLUs. So that's pretty interesting. 2.82, I think I said that is the percentage. So these are tiny compared to the big monsters like technology and finance and consumer discretionary and healthcare. But you don't have to buy them in their weightings in the S&P. That's the whole thing about what we call sector rotation, that some sectors very often are going up while the overall market is going down. Some sectors are going down even when the market is going up. And we saw energy, the weakness in energy, just the opposite of what we're seeing on a couple of these others. So I think it's a great idea to keep all 11 of them just the way we're showing them to you. And you can just quickly go through them, and it gives you an overall idea of what the next bigger in the hierarchy is, which is the stock market itself, in this case, the S&P. Then if you look at the other indexes, the S&P, the NASDAQ, the Wilshire mid cap, the Wilshire small cap, the Russell, you look at all these different indexes, they all have their own sector weightings, but you can pretty much be sure that any of the sectors that you're looking in the S&P will be acting similarly in all the other indexes. Now, on small indexes, like small cap indexes, like the Russell 2000, that sometimes is not true because they're very small companies, basically up to $2 billion in cap size. Mid-cap companies are between 2 billion and 15 billion. And so you put all that together, and it's a way of keeping track of the hierarchy that I've talked about in a number of my presentations. Let me just see something here quickly. Okay. That is number 9, utilities. Now the real weird ones. So what I'm going to do is go back to this. What is, can you see that?
No, I can't. Something is...
Okay, I'm going to stop. I think I know what happened. Here it is, right there. Okay, so can you see that now?
Yes. Yep, it's all good. Perfect.
Okay, great. So that's the utilities. Now we're going to go to real estate, which is number 10, which is XLRE. And it's 2.65 weighting. And it surprised me. I guess I haven't been following real estate too much. Now, as was the case with the communication services, there's not much history. They both started about the same time. Oh, that's the monthly. Okay, good. So we do have a little more. Yeah, we do have more history. So this one goes back to November of 2015 in terms of the history. That's when it was added. And the communication services, which was a combination of telecommunications, is only about a year and a half old. Okay, this is the strongest of all of them we've looked at. And here is the September sell-off into December, but we only went down to October, and then we rallied into actually higher, while the stock market and almost every sector we looked at continued down until December. Real estate turned around in October, went up to new highs before correcting and just barely took out the lows that it had right before. So even on the downdrafts, this has been the strongest of the sectors. Take a little bit longer look. This is 2016, 2017, and 18. At the beginning of 2018, right here is where the stock market peaked. No, I'm sorry. 2017, the stock market peaked, ran up into 2018. No, right the first time. Peaked right here, the S&P in most sectors. This is the first leg down. The second leg got back up to where the first leg was, and now we are way higher. If you say somewhere around $34 have been the highs of this over the last 3.5 years, you can see we're up to 37, so we're 10% higher, which is like the Dow over 30,000 and the S&P up close to that 3,200 mark. So this is unfortunately only 2.65%, but it is really on a tear, and I don't see anything negative. We're on a green 5 above a green 4. All Consensio is going crazy. So all of that looks really good to me. Anything from that you see?
Yeah, I could share a chart real quick.
Okay. Real estate?
Yep.
Okay, I'm going to get out of this by going here, going back here, stop screen share. Okay.
All right, we'll throw mine on right now. So I've been taking a close look at this for a while now, and this is kind of the pattern that I have been watching develop, and really thinking that this was going to be a topping pattern that caused the price to kind of roll over and then come back down this way, is really what I thought was by far the most likely. Breaking out to the upside of this is very bullish, and is something that I really just was not expecting. And that reason being is just pretty much looking to the left. This is a different chart than Tyler because it has more history. This is IYR, which is iShares Trust US ETF. So this is something that I was expecting it to top in this area, mainly because we had the prior highs right in here in 07. And back in here, everybody agreed that this was a bubble. I mean, even the laymen who don't really understand anything about finance understood that real estate was a bubble being valued at these prices up here. And they understood that because of the subprime mortgages. Banks were lending money to people who could not afford to pay back their mortgages. So that was creating demand for real estate that was basically artificial because these people couldn't afford to honor their liabilities. So everybody understood that right back in here at these prices that real estate is a bubble, and it's one of the biggest bubbles the world has really ever seen. Once it popped, it came down in a big way. So I am really scratching my head at this. Like, how are people looking at this chart and thinking that it should keep going up. I mean, on a short-term basis, it has been, but looking back, we're now approaching the valuations at the absolute top of the mortgage bubble in '07. And to me, that is a serious problem. And this thing, I would be incredibly surprised if it went on to create a new all-time high. I would have to ask myself, how is it able to do that? How is there able to be more demand right now than there was back then? And that's a question that I just really cannot answer. So this is a chart that I think
let me give a shot at it.
Please.
I think this is indicative of one of our key stories at Lucid, which is what happens when you print money and then put it through the banking system at more and more rapid rates. This period on the far left of the chart, starting after the 2001, 2, and 3 drop in the stock market, Alan Greenspan stepped in and he dropped interest rates down to 0. And he kept them at 0 from 2003 all the way through 2006 and 2007. And the biggest recipient of that money was not the stock market. It was the real estate market through mortgages. And more banks, more and more big brokerage firms, more and more insurance companies, trading companies like Goldman Sachs, as well as AIG and JP Morgan Chase and Merrill Lynch and all of the rest of them, they were making money hand over fist in the derivative markets of the mortgages. So when that finally broke with all the cheap money that kept mortgage rates very, very low and allowed mortgage lenders to come up with all these innovative ways of filling out paperwork to unqualified people, that is very typical of a bubble. And then it broke, and we know what it did to the economy, the stock market, and the world economy. What we've been arguing is the run-up in the stock market, the run-up in asset prices, and the run-up in real estate since then has much more liquidity than anything that went into the earlier bubble in real estate. And my evidence for that is we only had about $100 billion on the Fed balance sheet throughout that period. In this period, we have 4 trillion. In other words, 40 times more. More what? More money, more fiat money printed out of thin air in an attempt to keep interest rates as low as possible. So it does not surprise me in the least. In fact, you should ask yourselves, why isn't this chart 40 times higher than the previous peak? And obviously there's reasons why it isn't. But my point is that a lot of the money has gone into the stock market around the world, but particularly in the United States, over this 10-year period from 2009 to 2019. Some of it has gone into real estate, but you can imagine an awful lot of people not wanting to gamble on real estate this time around by buying second, third, and fourth properties using no money down, and even having the mortgage lenders pay you an extra 10 or 20% of the equity value on top to get you into new condos and all of the rest of it. On this run up, everyone that was destroyed during the drop you see in 07, 08, 09 in real estate is not exactly rushing back in. And so that's how I'd compare the two periods.
That's excellent. I'm very glad that you took the time to go over that. That was something that I was not able to figure out myself, but that makes perfect sense. If the money supply is much, much higher here than it was here, then the valuations of goods and services and homes should also correspond based on the dollar now having lost value since the supply has been increasing. So that is a great answer, and certainly I agree with what you say. And it brings up a question that I've actually been meaning to answer. Hopefully this is a good time, meaning to ask, I mean to say, and that's how you talked about recently how you determine your returns based against absolute returns, and
Right.
that's 0%. If you're beating 0%, you're happy. Whereas in my mind, if you're returning 0% consistently, or even in 1 year, you're losing because you just lost.
If there's inflation, that is true. So I'm really talking about zero as being a target after inflation. So if we've got 1 or 1.5% inflation, then you've got to try to get something above zero, which is usually very easy to do. But that's a good point. If we get up to 3, 4, 5, 6, 7% inflation, then that's the number you need to get. And it actually gets easier and easier as inflation goes higher and higher, because you get much more volatility in markets, both up and down, in an inflationary environment. Just think about the commodity markets in the 1970s, where there was always a place to park money in commodities like gold and silver or sugar and oil and on and on and on, because of inflation, as opposed to parking it in bonds or utilities that get hurt during periods of inflation because their yields are conflicting with the inflationary returns you can get even on money market funds. So that's a very good point. And zero, when I say zero, what that really means to me is just instead of S&P 500 returns, my target is zero. So what that means is if the S&P is up 20%, if I'm above zero, I've done the job I need to do for that period of time. I'm not happy with it because I should be up something like 18 or 19%. And in almost all cases, you will be if you follow the trends the way I've talked about them in terms of Consensio and other things. In other words, if nothing is trending, you should be able to get a zero return. If everything is trending down, you should be protecting assets so you get at least a 0% return. If things are trending up, then you take as much as you can out of the market. And that's going to be well above the zero price. The zero is really, in absolute returns, what that really signifies is you just never want to show an annual period with negative returns. And therefore, all of your systems are designed to prevent that. And if anything is trending upwards, then obviously you're going to find it, and you're going to be able to get well above zero on the upside. It's just in flat markets and down markets, your minimum is zero.
That makes a lot of sense. I'm glad you clarified that, and I'll be throwing off screen share. One other thing, a comment from Rad Vladdy on YouTube said that this looks like an inverted Adam and Eve, and that's something that I hadn't quite noticed before, but that sure as heck, if this thing doesn't really exceed the all-time high and rolls over like that, that sure would look like a massive inverted Adam and Eve. That's for darn sure. So I will be tossing it off there, and
okay, I will jump back on with our last, which is materials. And materials are XLB as in boy, XLB. This makes up 2.5%. It's the smallest of all the 11 sectors by weighting. Not much different than real estate or utilities, but it is right now the lowest. it probably was real estate and utilities until they both took off to the upside. And now XLB, the materials, is in the smallest position. Now let's just see what we're looking at here. Here is the peak in the beginning of 2018. Then we had a secondary peak in the stock market and then a tertiary peak before this sell-off. Materials had lower highs, about the same high, lower highs again, lower lows, lower lows, lower lows, lower lows. And finally, looks like they've, I'll just throw a real quick trend line on here. Let's go from here. Let's go from here through this. Yep. Just recently broke out of the downtrend on basically one candle, which was last week's candle. Now, materials include all kinds of goods produced that are measured in producer prices, but it's mainly building materials. It's aluminum and zinc and copper and tin, and as well as a number of other things like lumber. So they've been in a downtrend. Why? Because the dollar's been in an uptrend over this same period. We've had dollar weakness in the last week and a half, not much, but that might be part of the reason we had that pop. Just taking a look at, we've got a green 2 barely above a green 1, but it is above it. We have taken out the stop and reverse point, so we've got 2 weeks of support on the stop and reverse. We have turned barely the long-term moving average up. The intermediate cut through the long-term back here and was coming down on this move, but now it is flattened and is even the intermediate terms moving up, and that'll start moving up sharply. So a little early to say it's in a full bull market. It is with Consensio, with this price action this week, but it's still been a very tough place to park money. But maybe this would be an opportunity. Anything that you see on this one?
Yeah, this just looks like a good setup to me. One of my favorite sort of situations is seeing a trend line break combined with a moving average crossover. So we broke through the trend line, and now we're getting a crossover with the moving averages. That's following the long crossing, the medium crossing the long, and it's also after what looks like a nice higher low. So seeing a good higher low after this prolonged downtrend, and then a breakthrough of the trend line, and a moving averages crossing bullish, and that's also confirmed with the parabolic SAR on the weekly basis has just recently been broken. So seeing a lot of signs that this could be ready for a reversal and a move back to the upside. What I would be waiting for is that peak just recently to be taken out at about 58 that we're testing right now, that had that green 2, 3, 4, and 5 just to the left right there. So if we take out that peak, then I would be feeling confident that this thing is reversing the bear trend.
Yeah, I would agree with that. I didn't bring my chart with me. I've shown it before. If you look at all of the sectors, the 11 sectors we've just looked at, on an annual basis over a 10 or 20-year period, and you color code them into little boxes. So energy, let's say, is always green each year out of the 11 boxes. technologies, red, etc., what you'll find, and it's not just over the last 20 years, it's the 20 years before that, 20 years before that. I've taken it all the way back as far as records go. What you find is things that go up to the top of the chart. And if you just picture the top of the chart of the best performing for that year, and the bottom of the chart is the worst performing for that year, and you've color coded each one of these 11 things. So all you've got to do is you look across, and what you tend to see is certain things stay around the middle most of the time. Some things that go to the top, like technology, like finance, like energy, won't stay there more than 2 or 3 years, and then they will drop to the middle of the pack and all the way down to the bottom of the pack. And then they will repeat that, go back to the middle and all the way back to the top. And there's a lot of explanations for that. You can think of some, I'm sure, yourself, but basically what's happening is the market is shifting in terms of relative strength of the parts of it. And as things that are doing very well and earning a lot of money, momentum takes over on Wall Street, and not only sector rotators, but stock pickers will be picking those things that are moving because they've got strong fundamentals and technicals behind them, which drives them higher and higher up a chart like the one I just described. And I will bring one for our next show where I show you the last 20 years, and I'll be able to demonstrate exactly what I mean. But that's another very good way of getting a picture of what's going on with the innards, the guts of the market over time. And you can set yourself up because something sitting on the bottom for 2 or 3 years relative to all the rest is getting ready to take back off to the upside, and things that are up at the top are getting ready to drop. All we've looked at today is the recent 1 year, basically, and where we are technically right at this moment for those 11 sectors. Just to give you an idea that you always get 2 or 3 or 4 that are very strong relative to the index, 2 or 3 or 4 that are very weak relative to the index, and the rest are sitting somewhere in between. And what a sector rotator is doing is, as things weaken, they're getting out of those and putting money into those things that are strengthening. And by doing that, it becomes relatively simple to outperform the indexes. And with that, I will get out of here, and we are ready to take a look.
Kind of add to what you just said there in terms of it being relatively simple to beat the indexes. Just want to clarify how I'm understanding that and what we went through. So think about the sectors that we went through that were stronger and the ones that we went through that were weaker. So I've got written down the utilities, consumer staples, and technology as 3 of the strongest. And if you were weighting your portfolio a little bit more heavily into those sectors, right now the S&P has 20.84 in technology and 6.74 in consumer staples and 2.82 in utilities. If you instead had something like 5% in utilities, 10% in consumer staples, and 30% in technology, and those extra percentages were coming from the other sectors which were underperforming, then you would have beaten the market throughout those last years that the sectors that we identified were outperforming. So that's really all that it takes, is being able to identify sectors that are stronger than the counterparts and then weighting the portfolio more heavily towards those sectors at the expense of the underperforming sectors. And we just showed you how to go through each and every one and identify, oh, well, this one looks much stronger relatively. We've got higher highs and higher lows. This one is clearly much weaker, lower highs and lower lows. So we walked you through how to go through and identify the strength of each sector relative to one another. And then from there, you can determine how to adjust the portfolio and the allocations such that you are more heavily weighted in the stronger sectors, and you will beat the underlying index, which has a less heavily weighted in those sectors. So that's what I had to say there, and we are ready to take a look at some Bitcoin. Is that right?
Yeah. Let's take a look at Bitcoin, see what you're thinking.
Sounds good. I'm not sure if I'll have a whole lot to update from yesterday, but I'm more than happy to take a look. So yesterday, I was expecting and wanting to see prices above 8,500 basically by the time that we came on air today. I gave it about 16 to 20 hours, I believe, to get, we were on this candle from 82, 83 up to the 85 territory. That's based on this horizontal along with this channel, and that was determined by this swing target using from here to here, and that is what I was using to make that sort of prediction, or just more what I was wanting to see, what I was hoping to see this progress. And now we just closed this doji here, and it will be interesting to see if we are able to break through. This actually is a very significant area of resistance. And one thing I can show was that Tyler asked if this area, while we were on air yesterday, was important to me. And I replied no, that I thought. And sure enough, when he asked, I mean, this was a full-bodied green candle that was taking out these highs all the way up here, you know, looked something like that. And he asked if this was significant to me. I didn't think so, because we had just taken out this high, and I was expecting us to be able to achieve this swing target, and was disregarding this area. And sure enough, that was pretty much right after we went off air, the price started to reverse and pull back from that area. So just to kind of explain what why that might make sense is looking back at this run. This is just a massive run that took us from low 5,000s up to the low 8,000s in less than a month, like a few weeks. So a huge run, ton of momentum that went through a lot of areas of resistance. Took us right through 62 to 63, right through 6,800, and all that momentum, it died out at this price, at the 83.22 area. That is where this run came to an end. So that should signify that that's an important number. If that's where resistance was able to at least make this thing cool off and start to consolidate, then that could be important moving forward, such that we have just started a little run. If this area was important enough to stop this huge run, then it should be pretty important here. It did turn out to be not for very long. Support continued to move up. We got a little bit of another higher low right in here. And the reason why I say that this is a significant area, let me go ahead and get that out and that out, is if we zoom out and take a look at the weekly chart, we see, let's give it one of these guys. So right here, I'm using the bodies of these candles. Let's see here on July 23rd and July 30th, using those bodies, and then up to the wicks. And that gives us something like that. And then I change the color to red to show resistance. So we see that this is a significant area of resistance, at least in my mind, coming off of this prior peak from back in July of 2018. Using that to draw a horizontal shows that we are right in the thick of some resistance. And that is my most important sort of way to determine targets right now, is using these prior areas of horizontal. So this is definitely a significant area of resistance right here at the 84. Let's see, it's 82 to 84.50 area. So seeing that these prior two candles have wicked down and are finding some resistance from the top of that box is very interesting to me. And again, that was drawn using the bodies up to the wicks. So if we do break through here and we are able to support above 84, call it 75, then my target would become 96.34. Still, it's too early to make that call just yet. I'm saying that that's what it would become if we can support above 84.75, and that could happen in the next day or so. And that is what I would be expecting if we're able to take out this horizontal area of resistance. So what are you seeing, Tyler?
Yeah, I see the same thing. There's a Fibonacci up around 94, 94.70. There is the stop and reverse point, excuse me, the weekly setup trend line right around the 9,000 level. And then 10,000 and 11,000 are huge to me, as we've talked about many times before. So the fact that we have a 9 on the weekly sell signal, and then we're struggling on the next candle and have not taken out the top of that 9 candle, and makes me nervous that this is a 1 to 4 week pullback, and we've got another couple of weeks to go. So far, this is a pretty good looking week after the 9. And we've actually got a green 1 on that. I believe that looks like a green 1. And so next week, all we need is to take out the top of the 9 candle and get a green 2 above a green 1, and it basically negates the 9 and probably suggests we're on our way to another 9 to the upside that could take us a lot higher. But that hasn't happened yet. So my feeling is I've been waiting to get back up around that 8,800 level, which is where we sold half our position. And it's been a long wait since we were able to sell at 8,800 because the last 2 weeks have really struggled to make headway for very good reason. And the very good reason is the tremendous surge after we broke through the 4,800 level all the way up to 9,000, almost nonstop. And therefore, you assume it's going to take a while to digest all of that movement. And that's my explanation for the last 4 weeks. We really peaked out on week 7. Week 8 just kind of went flat. Week 9, it said, okay, enough of this nonsense. And we dropped sharply. But here in week 10 of this run, it's a very strong candle. And as was just pointed out, it's struggling where it should struggle, at overhead resistance from the prior highs. And because of that, you've got to give it time. But right now, you've got to be leaning into the direction that if we can get through this week, which we've only got a couple more days on, and then next week with some sort of consolidation, then it should be primed to break to the upside. If we don't, if we peter out here in the next day or two and drop back below 8,000 or 7,800, I think we could begin a move down to lower lows. Lower lows meaning down into the low 6,000s.
I agree. I definitely see what you're seeing there. I just want to check to see if that came back to test that, and it did not. Okay. So yeah, I definitely agree that if this thing does break down 8,000 in that area, then a return to 62 would be most likely in my mind. And I've heard you on numerous occasions say that price going sideways after a sell-off is bearish. And I'm wondering if you're feeling the same way about this sideways action that we have experienced after this bullish run-up. Does that look like a bullish sort of consolidation to you?
Well, it could be, but it's taken on this weird pattern that looks almost like a head and shoulders top. I don't think it is anymore because of the recent action of this week, or I mean this 4-hour period, or no, this last day, because it really went a little higher than it should have if we were working on a head and shoulders. It still could work because of the wick back there on that last 9 over to the left. Yeah, right there. We're right at that same level right now. So it's cheating a little bit, but if we were to drop below your parallel channel, and we've tried for 5 weeks in a row, 5 days in a row, and haven't been able to do it. But if we were to do that and then go down and test that 7,500 level, that to me would be a very negative looking pattern. But other than that, we are going sideways after a tremendous move up without too much damage. Now, some people would think that dropping from 8,000 down to 6,000 is a lot of damage. But then we went right back up again, and kept going higher all the way up to the 9,000 level. So to me, this is just a consolidation of a tremendous move up. It could go either way. Right now, the short term is looking bullish, but I'm a little bit nervous about the intermediate term, only because of its inability to hold the highs between 8,000 and 9,000, and then struggling so much to get back into that zone again, above right where we are right now. It's kind of, in my mind, needs to do its thing right now and pop and take out all those other previous highs, and then you got a very bullish pattern.
All right, I would agree with that. So it looks like we've got a little bit of time. I'm going to take a quick look at Ethereum here. Posted a chart recently, and think that I am wanting to share it with you guys. So get zoomed in here 1 second. So let's take a look at what we're seeing here. First, we've got this nice bull channel that started to develop after this bear channel was broken. And we broke through this bull channel on high volume back in the middle of May. So that's kind of step one. I love seeing breakthroughs of bullish channels. That's tells me to be on red alert for a bit of a parabolic continuation. So what do we have here on number 2? Right after we broke through this area of resistance on high volume, we also got a golden cross with the 50 and the Here's the 50 and the 200-day EMAs. We can see that the 200 was acting as resistance, the 50 was acting as support, price was getting squeezed in between, which is what I love to see, but we didn't get the cross until the price was all the way up here. So that is not going to be a buy signal for me. We just smashed through, went on a big rally, and just had a recent cross. So now after seeing that, I am waiting for consolidation or a pullback to signal an entry, and also wanting to see these spread out. Potentially could have front ran this a little bit when we took out the highs here. Right in here, you could have been pretty darn confident that a golden cross is going to follow. So just depending on how you want to trade, if you're comfortable front running a little bit, or if you want to wait for that confirmation. I wouldn't have been front running right here because it was at resistance, even though it created a new high. It was at resistance, and I wouldn't be wanting to buy right in here. So instead, waiting for this to consolidate and pull back, and it has done so in a bit of a bullish pattern, seeing a bull flag here with the pull in here, and that is coming on declining volume. Volume went up as price went up, and volume is coming down as price is consolidating and pulling back a little bit. Also getting early signs of a parabola, which is something I look for after seeing this breakthrough of a linear channel. That tells me the price is wanting to go in a more parabolic fashion. So looking at connecting these lows with these lows, and then with that pullback here, I'm very interested in this thing holding up. And now looking at where the entry would be, would want to wait for confirmation of this flag, wait for a close above, wait for 260 to get taken out. I've got stop market orders on the books myself. I'm not recommending anybody else does. I'm just showing what I am doing and showing the techniques that we're teaching you and how to trade them in real time. So here could have been an entry pulling back to the 50 EMA. Definitely like that action, but you would have to be very quick to catch that. Rallied sharply. So now I would be watching for this thing to confirm with a breakthrough of about 260 or so. That will decrease as this angle continues to come down. The area to confirm will continue coming down with it. So that's what I'll be watching for there. And then if we do pull back into these moving averages, I will be very interested in buying. I don't really want to see that happen because then my parabola and my bull flag would break down. So I don't really want to see that. But if it does, that does represent a high probability entry based on my system. And then one other chart that I wanted to share, hopefully it doesn't take me too long to find it. Let's see, and it's not there, son of a gun. Yeah, this is it, great. So we looked at the Wyckoff accumulation on the 4-hour on the Bitcoin chart, and it's showing up even a little better on the Ethereum chart. It's a little later to the game, but it's showing up very nicely. So let me get the archetype here real quickly, and we can see that we've got preliminary support. Here, let me just pull it up next to each other. Okay, so we've got this preliminary support, selling climax, automatic reaction, secondary test, and then secondary test in phase B is right here. And then Ethereum did get the spring. You want the spring to break down below the selling climax and below the support areas to provide the spring, which comes in phase C. So that's what we got here. And after that is where you want to be paying very close attention and looking for a higher low, a signal of strength, a last point of support. This was where I have mentioned that Wyckoff's, this is his favorite area to go long and make sure that all shorts are covered. And then he's not looking to add until the next higher low that's developed after breaking through resistance, giving us this signal of strength in phase D, and then pulling back. This gives us point number 14, which is his only other area to enter based on the Wyckoff accumulation pattern. So a couple reasons why I'm very intrigued with Ethereum. It's a very technical asset, or shitcoin, whatever you want to call it. And it's something that when it is developing technical patterns, I want to be paying very close attention, because in my experience, it tends to honor those patterns with a pretty good frequency relative to anything else. So that's what I had for you there. Anything you wanted to add, Tyler?
No, boy, that's exciting. I love looking at the application of that Wyckoff accumulation on some of these charts. I've never seen it so clearly shown, so I really appreciate that. I think people are learning a lot from that, and I'm sure a lot of people are trying to learn it themselves, because it looks really effective. I've never really used it myself. I learned about it years ago and just got away from me. But this will definitely be a tool I want to keep in touch with.
All right, that's great to hear. I certainly appreciate the kind words, and I do have a good resource for where to learn Wyckoff accumulation distribution patterns, and some good notes as well. Perhaps I'll consider releasing those. We'll definitely share the link for the where I learned about it, and can look at sprucing up my notes to share those as well. So thank you for the kind words, and I am excited myself to see how everything will be progressing from here, and appreciate you having me on. It's been another great week of doing shows with you.
Yeah, great. It's been a lot of fun in very volatile markets, very important markets, and we will keep the good times rolling. But for now, thank you all for watching, and I am traveling tomorrow, so we probably won't do one tomorrow, but we'll pick it up over the weekend. And with that, thank you, Socrates.
My pleasure. And one last question to ask. We could hear the poker chips in the background. How did the sit and go turn out? Did you win?
Actually, I came in second.
Oh, all right. That sounds like good enough to be in the money.
Yeah,
Way
exactly.
to go. All right. We'll catch you guys on Sunday.